One positive thing about any disaster is we can learn from it. And the coronavirus has been no exception. Hey, I'm Wes Wood, the income guy and founder and president of Wood Financial Group. And for nearly 20 years, I've specialized in helping hardworking Tennesseans just like you reach their retirement goals through income-based financial strategies. And if you're looking for the right solutions to achieve your own financial goals, I can help. Just reach out to me at retiretv.com or by calling 615-826-5749 during today's show or at any time. Even as we continue struggling to put this coronavirus pandemic behind us, we've learned a lot already from this once-in-a-lifetime century crisis. Governments have learned, scientists have learned, and hopefully you have too. And today we're going to look at 4 financial lessons learned from the coronavirus. And these lessons include: expect the unexpected, be flexible, don't ignore estate planning, and plan your retirement holistically. And joining me again on this week's show is David Scranton. Dave is an investing for income specialist with over 30 years of experience. He's also a best-selling author and television host. But before we welcome Dave, let's talk about lesson number 1, be prepared. When COVID-19 was declared a pandemic back in March of 2020, the whole world changed. The crisis affected every aspect of our lives. It hit us physically, mentally, financially, and it hit older people the hardest. Of the more than 600,000 Americans who died from the virus, most were over 65. In addition, the unemployment for workers 65 and over hit 15.6%, which is the highest ever recorded. Some people were forced to dip into their retirement savings. Others were forced to retire early due to layoffs or even health concerns. And these situations are all tough. But in some cases, they might have been minimized or even avoided with just some better planning. And that highlights the first financial lesson from the coronavirus: expect the unexpected. Although you can't predict a pandemic, there are some things that you can do to minimize the impact of any sudden life-changing event. And one of those things is to make sure you've got an emergency fund. That means enough savings to cover 6 months of living expenses. The money that you can have to buy you some time in case you do have that job loss, that illness, or some other emergency. Hopefully enough time to avoid any permanent financial damage. Your fund will even go farther if you don't have to pay it towards credit card bills, if you don't have debt. So paying down debt is another good way to expect the unexpected. Finally, know your risk tolerance. Although the stock market soon recovered, the huge drop it took at the start of the pandemic was really a wake-up call for some people. They realized that for the first time how vulnerable their nest egg was to a major market correction. In other words, they realized their financial strategy was wrong for their risk tolerance in the first place. And I'm going to talk more about that with Dave in just a second. But right now, you can learn by reading my timely report, 7 Risks to Your Retirement. It comes with your free retirement income kit, and you can get that by visiting retiretv.com or by calling 615-826-5749. But now, let's welcome back Dave Scranton, founder of Sound Income Strategies and the Retirement Income Store. Hey, Dave, thanks for joining me again today.
Oh, great to be back. Thank you, man. Listen, so this concept of paying down debt and building an emergency fund, I get people asking me all the time, well, what comes first? Because if I pay down the debt, I don't have an emergency fund, I can get pushed back into debt. So should I have an emergency fund at the same time? And my comment is that they typically tend to go hand in hand in many ways, right?
They really do. That's kind of the chicken and the egg, right? But They really do go hand in hand. Sometimes I see people, they'll build up an emergency fund, but then not pay down the debt, just spend the extra money. And if you're having to pay on credit cards and other debt, it could siphon away some of that emergency savings very quickly. So I think they do really go hand in hand. Get that 6 months sitting in the bank. Get that debt paid off as much as possible. And if that emergency does come up, you can be much better prepared, and you won't have to maybe dip into those retirement savings. You won't have to dip into that savings that you were building up for another large expense down the road, and really set yourselves up in a better financial situation just by getting that debt paid off and getting that emergency savings established.
And the other thing that kind of goes hand in hand in a way, even though it's not as obvious at first glance, is knowing your risk tolerance, right? Because that affects all the rest of it too, right?
No doubt about it. And like I mentioned earlier in the segment, I think the big crash that happened back March of 2020, when the market dropped nearly 40% in 2 weeks, was quite a wake-up call to a lot of people. And if you didn't know what your risk tolerance was before then, you probably realized what it was after that happened. And so understanding what your risk tolerance is, whether you're aggressive investor, a moderate investor, a conservative investor is important in order to devise a plan to put in place in case we were to go through another major financial crisis like we just saw last year.
And how risky or how conservative your investments are also plays into how much you need for an emergency fund, because if you're in a riskier portfolio, your investments take a big hit, now you may need a bigger emergency fund. But that's why, you always talk about, I always hear you say that in some ways, investing for income has to do with, it built into it is expecting the unexpected, right?
Yep, that's right. And expecting the unexpected can come, at the hand of anything. It doesn't necessarily have to be a pandemic. I think the coronavirus was at least something that we've learned from, but a lot of other things can affect people. Even major lifestyle changes, losing a job, a major medical expense can pop up. And investing for income can help, make sure that your investments are aligned with your goals, especially if you're a few years away from retirement, which, having that emergency savings in place, paying down that debt, investing for income, all kind of go together when building the right and appropriate financial plan, especially when you're nearing those retirement years and preparing for another event. But Dave, thank you again, and stay with us. We're going to talk more in just a minute, but coming up after the break, I'll talk about the next important lesson to take from this coronavirus pandemic: the importance of flexibility. I'm Wes Wood, the Income Guy, and you're watching the Retirement Income Show.
A fiduciary is someone legally obligated to act in your best interest. Doctors, lawyers, and some financial advisors are fiduciaries, but not all. When you work with Wes Wood and his team at Wood Financial Group, you are working with fiduciaries. They help clients create customized investment portfolios based off their retirement goals. If you're ready to work with a fiduciary, visit retiretv.com and schedule a free, no-obligation conversation with Wes or a Wood Financial Group advisor.
I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
If you're age 55 or older, our free Retirement Income Kit is for you. Learn the fundamentals of investing for income. Discover potential hidden risks to your retirement plan. Visit yourincomekit.com to download your free Retirement Income Kit. Retirement accounts like 401ks and IRAs are great tools to save for retirement. They offer tax advantages to help keep more money in your pocket. But withdrawing money from your accounts can have a huge impact on your tax liability. Take money from the right account at the right time and you could minimize it. But taking money from the wrong account at the wrong time could result in a big tax burden. If you're not sure what you should do with your 401k in retirement, visit retiretv.com to schedule a free, no-obligation conversation with Wes Wood and Wood Financial Group.
Hey, welcome back. I'm Wes Wood, the Income Guy, and today we're looking at 4 financial lessons learned from the coronavirus. So lesson number 1, expect the unexpected. Now let's talk about lesson number 2, be flexible. And when I say be flexible, I don't mean a financial plan that you can change on a whim. I mean a plan that is modified based on changes in your life. And as we've talked about, the pandemic was a life-changing event for many, many people. millions lost jobs. Some had to change their goals, delay their retirement, or even retire early. And some realized that they were carrying too much financial risk. And when things like that happen, it's important to have a financial plan that can adapt to your new goals, your new needs, and circumstances, of course. And investing for income is exactly that kind of plan. In fact, the pandemic provided a good example of how flexibility keeps your income strategy viable even in the face of big market changes. For instance, when the economic recovery strengthened earlier this year, long-term interest rates took a big jump. And that did create some headwind for some income investors due to the inverse relationship between bond values and interest rates. When rates go up, bond values go down, and vice versa. However, the effects of the headwind were greatly minimized by many income portfolios through diversification and active management. In addition, income investors who wanted to lower their risk during the pandemic were able to, while those who wanted to increase their risk as the economic recovery happened, they were able to make that change as well. That's the kind of flexibility you want in a financial plan, and it's the kind you get with investing for income. And coming up, I'll talk about two more important lessons from the coronavirus. And those are, do not ignore estate planning, and be sure you have a plan for retirement is holistic. But right now, here's your chance to order your copy of my timely report, 7 Risks to Your Retirement. And it's free with your retirement income kit, and it's all yours by visiting retiretv.com or by calling my office directly at 615-826-5749. But now let's welcome back income specialist David Scranton. Hey, welcome back, David.
Yeah, Wes. You know, I think it might be worthwhile mentioning to your viewers that, having flexibility doesn't mean changing direction every time the wind blows in a different direction or they get a hot tip. In other words, it's not about flexibility for changing things willy-nilly, because you want to stick to a long-term strategy if you can, but it's having the flexibility to change if you have to, but not willy-nilly.
That's right. Yeah, not willy-nilly. A lot of times when people are constantly changing their investment portfolio, when it's based on emotions, just because the market's dropped, they get scared and sell, for instance. Many times that's going to create underperformance. That's not the way to invest. It is a good idea to maybe commit to a particular plan, but when we think about flexibility, we think about flexibility when it comes to your portfolio. And that can change. The flexibility may happen when there's opportunities out there, right? When the coronavirus hit, it gave us quite a bit of opportunities to buy into, and we were able to take advantage of those. When interest rates spiked, and it created some headwinds for some of the fixed income markets like bond funds or bonds, then it was a good idea to be diversified and flexible to mitigate that and keep the interest and dividends relatively good while going through a little bit of a headwind with the income model. So being flexibility doesn't necessarily mean with the plan, it just means to be able to take advantage of opportunities as well as perhaps lower some risk when things get troublesome.
And having that flexibility be opportunistic, yeah, it's important in a growth-based model, because if you think something has more growth potential than another, you want to be able to make the change. But your crystal ball may not always be right. But flexibility is even more important with the income-based model, like you talked about for a bit, because that's not a crystal ball issue. And if you want to engineer inflationary increases for your clients, then that flexibility is more important in the income world than it is in the growth world, right?
That's exactly right. With inflation, that's something that we definitely look at because as time goes on, cost of goods and services are going to go up, and for folks more on a fixed income that need the interest and dividends from their portfolio, we need to make sure we've got some types of positions in that portfolio that we can be flexible with when investing for income to give us more perhaps income down the road for our clients. So what happens a lot of times, though, in my industry is that a lot of people just set it and forget it, if you will, and just sell a plot of goods and services and investment products and never really do anything with it. And that just, quite frankly, doesn't work in the income model. It's good to have it managed, good to have it serviced, good to make sure that you're making adjustments inside of that portfolio as a money manager to keep up with the ever-changing economies that we're finding and we're seeing right now.
It's funny, in a recent show, we talked about being a fiduciary. And I don't understand how somebody could be a fiduciary if they don't have flexibility built in their clients' plans. So if you have these 5 or 7 cookie cutter portfolios that an advisor is, working legally under the auspices of a fiduciary, but just putting you in one of those cookie cutter plans and setting it and forgetting it, to me, it almost seems like, this fiduciary rule we talked about recently needs to account for that, because that's not really acting in the best interest of your clients.
No, that's right. And, there's a lot of advisors out there, I hate to say it, but are acting, as if they're a fiduciary, but really just using cookie cutter portfolios, in my mind, isn't a true fiduciary in the best interest of maybe somebody's clients. A lot of advisors may do a simple risk tolerance questionnaire, ask a couple of questions, and pick from one of these cookie cutter portfolios. And a lot of times those cookie cutter portfolios are just set it and forget it. Maybe it's a 50-50 mix, or 60-40 mix, or 70-30. I'm sure a lot of my listeners now and people that are watching this show today have heard that before. But as a true fiduciary, it's better to really sit down with the client, understand what their needs, their goals are, their risk tolerances, and then with them customize a portfolio for their needs. And with that, always be talking to their clients, reviewing their clients, and making those adjustments based on their particular unique situations or to what's going on out there in the financial markets and in the economy. That's right, Dave.
Yeah, it's funny. I just had a call just a couple days ago with a client who's a retired doctor. I don't know, I think his wife got tired of him sitting at home. She kicked him out. He went back to work. And, all the income we were generating now, we need to close down the faucet and reinvest it for a while because they don't need it anymore. And, things change, right? There's even a commercial where the guy comes into his financial advisor and says, change of plans, right? It happens all the time. You see it?
It does. It happens all the time, even with folks that are well into retirement. But good point, Dave. And thanks again, and you stick around. Coming up, I'll talk about 2 more important financial lessons that we've learned from this coronavirus. Hey, I'm Westwood, the Income Guy, and you're watching the Retirement Income Show.
Retirement accounts like 401ks and IRAs are great tools to save for retirement. They offer tax advantages to help keep more money in your pocket. But withdrawing money from your accounts can have a huge impact on your tax liability. Take money from the right account at the right time and you could minimize it. But taking money from the wrong account at the wrong time could result in a big tax burden. If you're not sure what you should do with your 401k in retirement, visit retiretv.com to schedule a free, no-obligation conversation with Wes Wood and Wood Financial Group.
Hey, welcome back. I'm Wes Wood, the Income Guy, and thank you for tuning in to today's show, titled 4 Financial Lessons Learned from the Coronavirus. And so far, we've looked at lessons 1 and 2. Number 1, expect the unexpected. And number 2, be flexible. Now, let's focus on lesson 3 and 4, which is, first, don't ignore estate planning. And number 2, plan your retirement holistically. Again, like I mentioned earlier, most people who died from COVID-19 were over 65 years old. And many of those folks were on life support at first before they passed away. And during that time, how many families agonized over what to do because they had no advanced care directive? And how many victims of the virus died without leaving a will? A will and an advanced care directive are both important parts of your estate plan. As an advisor, I stress the importance of estate planning all the time. And the pandemic gave us another stark reminder of why it's so important. It reminded us that tragedy can strike at any time. And the older you get, the more vulnerable you are to a major medical threat, healthcare event. And with that in mind, I recommend taking 1 or more lessons from the coronavirus to heart. Remember to plan your retirement holistically. And as the saying goes, health is wealth. And that message resonates more strongly than ever thanks to the pandemic. So make sure you have a retirement plan that encompasses every aspect of what it means to be healthy. Not just your financial health, but also your physical, mental, and emotional health. Your financial security isn't worth much if you're not healthy enough to enjoy it. And neglecting your physical health can make you more vulnerable to something like a deadly virus. And what's more, poor physical health is also likely to affect your financial health by increasing your medical and healthcare costs over time. And at the same time, mental and emotional stress can also affect you physically. So the point is that since physical, mental, and financial health are all naturally connected, it only makes sense to make sure that you have a holistic approach to your retirement planning. And the good news is that investing for income gives you that holistic approach by helping you build a strategy geared specifically towards your retirement goals and designed to reduce financial stress. Before I welcome Dave back, I urge you to learn more by getting my free report called Estate Planning. It comes with your free retirement income kit, and it's available by visiting retiretv.com or by calling me at 615-826-5749. Now, let's welcome back income specialist and founder of the Retirement Income Store, Dave Scranton. Hey, Dave.
Hey, Wes. Let's talk about estate planning for a minute. It always surprises me about some of the different misconceptions about estate planning, starting with who does and doesn't need an estate plan, right? I mean, you know what I'm talking about there, right?
Yeah, the misconception is that an estate plan is just for the high net worth, the super wealthy. But really, whether you have $100 million or $100,000 or less, it's important to have an estate plan. An estate plan isn't just the guarding against taxes and other issues. It's like what I talked about earlier, having an advanced medical directive, making sure you have a will, things that are inside of your estate plan that spells out exactly what you want to have happen to you in the event that you're in one of these situations. And with the coronavirus, it really was a lesson for a lot of people that, hey, we need to get our act together. But yeah, a lot of people think that they need to have a lot of money or assets in order to have an estate plan, and that's just simply not the case.
You think that, changing subjects for a minute, do you think that most people do know on some level that their financial, physical, emotional health are intertwined, but maybe they just struggle with how to build that holistic plan?
Yeah, I think that has a lot to do with it. I mean, I see a lot of folks and meet with several folks from this show, from radio, that come in, and I can tell that they're stressed out, and they're stressed out about their finances. And a lot of times it's really because maybe their investments are not aligned with their goals, and they're just not certain what they have. And what happens a lot of times with that stress is that it also creates, mental issues, and perhaps stress can lead to physical issues as well. So it all really works intertwined. And if somebody's in a situation where they're just stressed out about money all the time, well, that's not the kind of retirement that they deserve. And fortunately, with the income model and investing for income, it may be a solution to a lot of these financial stresses, which could help mentally and physically for that matter.
Yeah, we saw that back 18 months ago, right? When the coronavirus crisis first hit, the market had plummeted by well over 30%. I know I saw from my clients that being income-based really did reduce their stress because they realized that even though their net worth dropped on paper, it didn't affect their retirement income at all.
That's right. Their income wasn't affected. They knew that they could still rely on that steady stream of income that they're drawing from their accounts. Like we always talk about, that their eggs from their chickens were still the same. And as long as you're eating your eggs and not your chickens, by definition, you're not running out of money. When that pandemic hit, back in March, remember the market went down nearly 40% in 2 weeks. It was drastic. And we put out videos to clients, explaining, what to look for, and give us a call if you have any questions or concerns. But I think fortunately for us that we've been preaching this income model, investing for income, for quite some time, we got very, very little calls. But the people that we did talk to said, hey, they thanked us for just getting the word out there.
And those that were retired.
Yeah.
Those that were retired were happy because their income didn't drop. But the happiest clients, as you know, were those who weren't yet retired, who were reinvesting all that income. Because now when the prices of these things dropped, and they reinvest it, they bought things cheaper. They bought them on sale. So their future income between now and retirement went up more rapidly than it would have had the drop not occurred. So those were some of the happiest clients I found.
That's right. It's funny to think that sometimes a drop in value in an income investment isn't necessarily a bad thing, especially if you're not spending the money, because like you said, you're able to take those eggs and buy more chickens, which produces more income later on. But yeah, all these things really go hand in hand. Getting that estate plan in order, and then also making sure that physically you're in good shape, mentally, and of course financially, which is something that we can help with. But Dave, thank you for joining us today. I'm Wes Wood, the Income Guy. Thank you for watching, and if you have any questions about what we've covered on today's show, please reach out to me at retiretv.com or by calling 615-826-5749. Hey, we'll see you again next week.
A fiduciary is someone legally obligated to act in your best interest. Doctors, lawyers, and some financial advisors are fiduciaries, but not all. When you work with Wes Wood and his team at Wood Financial Group, you are working with fiduciaries. They help clients create customized investment portfolios based off their retirement goals. If you're ready to work with a fiduciary, visit retiretv.com and schedule a free, no-obligation conversation with Wes or a Wood Financial Group advisor. Retirement accounts like 401ks and IRAs are great tools to save for retirement. They offer tax advantages to help keep more money in your pocket. But withdrawing money from your accounts can have a huge impact on your tax liability. Take money from the right account at the right time and you could minimize it. But taking money from the wrong account at the wrong time could result in a big tax burden. If you're not sure what you should do with your 401k in retirement, visit retiretv.com to schedule a free, no-obligation conversation with Wes Wood and Wood Financial Group.